Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. We'll scroll through the comment section. Also had some comments on the sidebar of one of the videos that I released that I was talking with everybody. Some of you guys wanted top 10 stocks, strategy video, more quantitative analysis. Maybe if you had $10,000, what would I do with it? I mean, that's all. I mean, top 10 stocks, $10,000 video strategy, that's all the same thing, I think. Is what investment strategy do I have, or what investment strategy does someone should have, I should say. And I think that varies quite a bit from person to person. You have to buy what you know and what you like and what you can hold on to. I'll say this again, and I've said it on the channel before, is you have to know how to value assets. You have to know how to value, like, what is of good value and when does it become expensive. So the strategy that I developed over time is linked with ratios, and I use ratios for that valuation. And the valuation is like commodity to stock ratio, or an oil to gold ratio, or the gold to money supply ratio. And then what I did is I dove down into it to see when the ratios would revert from an undervalued state to an overvalued state. And that's your market conditions, because they reprice themselves under certain market conditions. So the strategy is riding that valuation runway from undervalued to overvalued over time. And the market conditions that I found that were favorable for commodities is an expansion phase of real estate, which is inflationary. And under inflationary periods, it causes the herd being humans interacting with each other, it causes the herd to invest differently. So they prefer, under a highly inflationary environment where you have real negative rates on your bonds, to not buy bonds and to buy something else like an inflation hedge, like precious metals or commodities. So that's what's playing out right in front of us. We can see it in the ratios changing against each other. I've shown a lot of videos on the commodity to S&P 500, how commodities are starting to outperform the S&P 500, how it bottomed and broke the long-term downtrend. It's starting to come back up. We've got a lot of, like, the oil to gold ratio, or gold to oil ratio. Oil is outperforming gold. We're starting to see all these things take place. So the strategy here, in my opinion, is to buy these undervalued assets and hold on. Now, I can put awesome picks in front of people, amazing picks, and you're going to have to be able to hold on to them. You're up 100% or 200%, I'm not selling it. If the valuation runway is still ahead of us, I'm holding on. And I've got picks that are up 25 times in 1 year, a little over 1 year. They're up 25x. I'm investing for 100 baggers. And another strategy that I deploy, not only is that kind of the big strategy there, I also use investing strategies. So here's a strategy. Hopefully I can describe it well enough. Is there's companies that can return quite substantially. I'm going to call them 100 baggers. 100 bagger is 100 times your money. Now, you're going to have to be able to hold the entire way through that. Most people, they can't hold through it. They'll sell it. They go up like 2 or 3 times their money and then they sell it. I'm talking about 100 times your money. You're going to have to ride through this. So one, you're going to have to be able to do it. You're going to have to know the valuations of assets and how these market conditions interact with valuations. That's a critical component here, because if you're going to get a 50 bagger or 100 bagger, which means you get 100 times your money, $1,000 into $100,000, you're going to have to be able to hold through it. And I don't think most people aren't going to be able to hold through it. Now, a strategy is, would you rather, let's say you've got a large company. Let's say they can go up 10x, maybe 20x at best, but I'm going to say 10x. it can go up 10x. And you say, well, it's lower risk. I'm going to put all my money in it. Let's say you have $10,000. If you put 10,000 in it, and let's say it's a high probability of getting a 10x. So you do 10 times 10 is $100,000. Now, let's say you go into some other companies that you're looking at. Some of them could be 100x. Maybe even some could be more than 100x, could be 300x. But let's say there's 10 companies that possess this trait where they could go up 100 times or more, or they could be flops. Maybe they only go up 2x, or maybe they don't go up at all. But let's say there's 10 of these companies that possess that power to go up that much in a sector that is very powerful and leveraged. Leverage being that the price of that commodity could go up substantially. We'll call it uranium. Now, let's say you've got 10 grand, you've got 10 companies that possess this. Why not put $1,000 in each of those 10 companies? If one of them does 100x, just one, you've matched your return on the other one. Everything else is just icing on the cake. Now, some of these bull markets, there's not that many companies, a lot of money piles into it. Maybe all of them go up at least a 20 or 30x at a minimum. And then some of these other ones would go up a lot. Now, I don't think we're going to get this type of return from where we are today. But from the bottom of the market, yes. I'm just describing a strategy. So my strategy, if you look at my strategy, is I scan the entire market. I scan for everything. And I say, okay, these are the cheapest sectors. Platinum's very cheap right now. Silver's very cheap. I think copper's, it's not as cheap, but there's still good deals out there in copper. It seems like the mining companies haven't gone up as much. You can look at nickel. Nickel's still cheap. We look at some of the energy sectors like uranium is still incredibly cheap. I bought oil and natural gas when it was incredibly cheap. It's getting a little bit more fairly valued now. And gold still, there's a lot of cheap gold companies as well. I look at all these things. I look out across the entire, undervalued assets in the world, in the markets. And I go after the ones that I swing for the fence. I swing for the fence. I go for the ones that are real volatile and can boost the returns quite dramatically. And what I do is my strategy is to not put too much into any single one of them. It's 5% or less in the portfolio. And I dip my money in all those because all I need is a few to just rip it. Some of them I overweight because I think they have a better chance of doing incredibly well. I overweighted SM Energy and I got real lucky there. I overweighted CDEV, Centennial Resource Development. That one's done incredibly well as well. I've gotten companies like Athabasca Oil. That's over 1,000% from where I bought it. I've got other ones. Crew Energy's up a lot. There's a whole bunch. I spread out amongst what I thought were the best opportunities. And I've got a bunch of companies that are over 5, 6, 700%. And SM, I think I'm up a 25x already. So how did I do that? How can we recreate that? I bought it when the valuations were incredibly cheap. And when people were telling me not to buy it, they're saying oil's never going to go up over $40 a barrel again, ever. It'll be around 30. It's like, all right, whatever. I'm buying it. The ratios tell me to buy it. And I don't think that I think the dynamics have changed where oil could go far higher than maybe even $250 a barrel. Yeah, crazy speak. I know. Why do I say that? Well, renewables aren't working the way that they're supposed to. And I can tell you this, they're still not investing in oil. And I don't know if renewables can replace oil. So everyone assumes, now I'll just talk about this real quick. Everyone assumes that renewables can replace oil. My question is, what if it can't? What if us going away from it causes massive problems? What if the renewables cannot replace it? What if the energy densities or energy returns aren't high enough on renewables to replace it? What if they're not reliable enough? What if we don't have the grid that can support it? What if electricity can't replace what oil can do? I don't know. I'm just throwing it out there. Everyone thinks that we'll just replace it. It's no big deal. What if it is? What if it is a big deal? So I'm taking that opposite bet. I'm saying it is a big deal. I'm saying that the number one commodity in the world can't be replaced with electricity. And if you put EV cars, what are we going to replace? 3% of oil demand? 6% at most if we basically put in like 40 or 50% of the cars in the United States? And we're growing? I think we're going to take whatever energy we can get. We're trying to grow economies here. We still have growing populations, and I just don't think. Off that subject, but the strategy, though, I'm looking at all these different assets out in the world. I'm plunking money in what I think are the best assets with asymmetric bets. An asymmetric bet means huge upside, limited downside. That's why I'm looking at the valuations. That's why I'm looking at the technical analysis on the charts. Now, looking at fundamentals versus technicals. Fundamentals may not give you what you want. I mean, you can have an undervalued company and it will never reach its full potential. Maybe people just don't like it. I don't know. There's a whole bunch of different reasons. That's why technical analysis will give you, I think, the edge up. You look at a sector that's been beaten down because you know the valuations are good. When that commodity reverses to the upside, these balance sheets will change dramatically. And if you can see that the company sold off dramatically and they're bouncing up off their bottoms with very good buying pressure, and maybe they're getting shorted to heck too, we can get short covering and just blow this thing up. That's what I saw in SM Energy and Centennial Resource Development and some of these oil companies. I don't know how you could see that through the fundamental analysis. If you did fundamental analysis, you probably wouldn't buy it at all. What I did is I looked and I saw the buying pressures and the volume and how someone was accumulating it at the bottom. So my strategy is to find those companies where you're getting these huge bounces off their bottoms and they're getting accumulated quite dramatically in terms of volume. If they've got the bounce, that's your ability to really rip it on the upside. They got to be able to move. Companies that I see that in, SM Energy, Centennial Resource Development, RECAF, Reconnaissance Energy Africa. They have that bounce. They're getting shorted to heck. And the shorts are going to have to cover if they find something big. So that's some of the companies that I looked at. Now, uranium companies, they're the same way. There just isn't many shares of it, and there's going to be a whole bunch of money piling into it. So the most leveraged sectors, in my opinion, are oil and natural gas and uranium, the energy sectors. They have the most leverage of anything. You can also have, and they're slightly delayed behind it, some of these silver companies, and I think silver companies are a good spot to be too, and I own a lot of silver companies. There's a couple of, that one platinum palladium company, PLG, looked pretty good. It looked like when we came all the way back to like $1.75, $2, low downside risk because we had a bunch of support underneath it, good upside potential. And I think that with the chip shortages in the cars, it slowed demand for palladium and platinum. When those chip shortages come back, I think platinum and palladium demand is going to go up through more cars being produced. So I think that's also another catalyst to really turn this thing and get it to move on upward. Now, some things that I'm thinking about, one thing in the supply chain, chip shortages, basically caused a demand short, it screwed up the demand for certain items that go into cars. It slowed that demand. Palladium, platinum, and all these other ones, rhodium, there's a whole bunch. And I'll be honest, you're not going to be able to think of all the possibilities of what could potentially happen in an energy-constrained world. There's possibilities that, the way that I always looked at it is that mining companies would struggle to get it out of the ground under very high energy costs. Drives the cost curves way up, and then they become uncompetitive because the commodity price has to go far higher. So I always thought, off the top of my head, that metal prices would go far higher, far higher, based off of higher energy input costs. And that's really kind of what history has shown. Now, we could have a different dynamic where we literally can't produce things. Like China, I think, is shutting down factories and limiting how much factories are open. And that may slow down how much production of goods are being produced. So maybe we don't need nearly the amount of metals and inputs from production. And maybe that has an impact on some of the pricing of things. So it's pretty dynamic, and there's a lot of things that I'm probably missing, because I don't think we've had energy shortages that could be as widespread as we could potentially have. And maybe it'll never happen. Hopefully it doesn't. But yeah, I've just been thinking, and I've always been a precious metals guy, physical holding, so physical, not the ETFs, just physically having it. Because at some point, this debt system, it's not gonna keep going, and the whole world is involved in it. So when you look at a strategy, a portfolio strategy, I always put precious metals as an anchor in it. And for me, it's always been like 20 to 25%. It could even be 30. You could do 33% precious metals, 33% real estate, and 33% equities, or something like that. And then you just keep building that. But yeah, I'm just trying to think, if this debt starts to implode, if we have energy shortages could be a prelude to the debt imploding, because everything's predicated off of growth, and growth is predicated off of an increasing energy supply. If you get short on energy, and let's say we remain short, I don't know if we are. Again, this is just out there thinking. If you can't grow that GDP, your debts are going to start to default, and debt defaults, I mean, this could be worldwide. If we have an energy shortage worldwide, that means that value that was in currencies is going to be transferred to something else. What is that something else? And historically, it's always been precious metals. And now people are going to say it's going to be crypto, but I don't buy it. I'm not sold on crypto taking that value out of the currency and putting it into that cryptocurrency. If you have an energy shortage, these things are energy hogs. They're super expensive to transact in. And I mean, maybe some of it goes there. I'm not a believer in it. I just don't. I want it off the grid. I want my wealth stored outside of the system. I don't want people trying to get at it, stuff like that. And cryptos, you can see every single transaction. You know who's got what. So that's something I'm like, I just don't like that. So if the debt starts to implode, you have to somehow bet against that debt. I mean, it's massive amounts of debt, and all of that value will transfer to something else. And historically, it's been precious metals. That's where people run. And if it's worldwide, what that means is that if this were to happen, huge if it were to happen, everyone is going to run at precious metals with everything they've got. What kind of scenario does that look like? What's gold going to be priced at then? And I heard, like, this was a while back, that if everyone ran at it, it'd be like $250,000 an ounce. I don't know if that's true, and that was a long time ago. It's probably $1 million an ounce or more, with all the money creation that we've had since that. That was probably 10 plus years ago. And we've been printing money like no other. Remember, it's just a dollar value. And I'm not calling for it. I'm just talking kind of out there. So I think a strategy for me, when I look at my portfolio, is physical metals in case that debt, something happens to that debt. I'm out of the system, and all the value gets transferred to it because everyone's going to run to it. I also have a lot of energy investments, because in a commodity bull market, you're going to have energy go up, and if we have an energy crisis of some sort, well, I have investments in it. And I also have the strategy of playing the renewable build out, renewables and electric vehicles. So I have rare earth metals. I'm in a lot of rare earth metals, in copper, nickel. I'm in tin, because tin I think is a good one. And I only have one company, Alphamin. That's my tin company. And then I do think, looking way out in the future, I think uranium could be a really good bet. I think more adoption of uranium is gonna be pretty good. So top 10 stocks, if I were to have, I look at sectors. I don't really look at stocks. I think rare earth metals, you got to have something there because they can blow up. There's not much of them, and they're almost all in China. So I use the ETF REMX. Copper's good. I like Nova Royalty. That's a copper nickel royalty company, and I'm sure there's more than just that. EMX Royalty is another one that has some copper and other metals in it. So I buy that one. I like the royalty companies, diversified, a little bit lower risk. I think they have good leverage. Teuton Resources is another one that I own. It's a small little royalty company in a high cost area where they own royalties on all the properties that they had owned. Energy and uranium. I have uranium. My favorite companies, maybe like a Banner, like they're mostly African companies. Bannerman, Forces Metals, Deep Yellow. I like those three there. Goviax, Global Atomic. Those are my favorite. There's other ones too, like UROY, Uranium Royalty Corporation. I think that one's good too. So I own those, and there's other ones too, guys. They're all pretty good. And then for my favorite for the oil and gas is SM Energy Centennial Resource Development. And then there's other ones like Crew Energy, Sandridge is really good. We've got Athabasca Oil. They're all good. All these ones that I own, Tellurian's good for liquefied natural gas. They're building a terminal. I mean, they're all the ones. Contango Oil and Gas. They're all good. I don't really have I mean, my favorite's SM just because it's returned so much, and I think Centennial Resource Development has a lot of potential as well. And then silver companies, in terms of leverage, like a Discovery Silver, they've got a lot of metal in the ground. It's just low grade. They probably wouldn't do well in a super high energy shortage environment, but if we don't get that environment, they've got a lot of metal in the ground, at least if we are short silver as we build out the renewables. I think we only have something on the lines of 20 years of reserves left at current prices, something on the lines of that. Metallic Minerals is one I own. Impact Silver, Koya Silver, Aftermath Silver, all these little silver ones. I own a lot in those. I own Endeavor Silver and First Majestic. Mag Silver. Anything with silver in its name, it seems like it's found it in my portfolio somewhere. Hecla Mining. Some of those kind of mid-cap, bigger companies as well for the silver side. And I'm mainly silver for the mining companies. Which one's the most leverage? I don't know. I would think Discovery Silver might have some pretty good leverage, hopefully. But that's I think that answers a lot of the strategy that I have in my stocks that I own. If I had $10,000 in terms of how I would deploy it, I'd probably stick with the ETFs at that point. I would buy URNM, REMX, COPX, that's copper, XLE, which is exploration, production, and oil. And then maybe I'd throw in a couple of individual companies that are like royalty companies, like a Nova Royalty, EMX Royalty, maybe a Franco-Nevada Royalty or Wheaton Precious Metals, something like that. And then I would spread out amongst all those. I think that's a pretty low risk way to play it. You've got precious metals coverage with the royalty companies, and you've got your other coverage in the ETFs. You start getting into individual companies. I mean, if you're swinging for the fences, maybe, but I don't know if I'd do that if all you had was $10,000 to invest. I would look more at getting the for sure returns than trying to speculate on some of these individual companies that we're doing. But if you're going to speculate, and I'd maybe put a little bit in some of these uranium exploration companies, just a little bit in each. And then, maybe it's only $200 in each or $100 or something like that. And then the rest, lower risk stuff or physical metals as well would be a good place to start. Because you got to, if you're young and let's say you're accumulating wealth, you got to hit the stuff that will for surely return during this bull market. You can't go after the too risky stuff in its entirety. And I know people think I'm young, I can take all the risk in the world. Well, you're young and you can compound this stuff even longer, so you don't need to take the risk necessarily. Go after the good returns and the for sure bets. That's what I think I would do if I could do it all over again. And I would have made a ton of money just doing the physical swapping game in precious metals. Check out my video on that, on how to look at ratios and swap metals from one metal to another metal, increasing your ounces over time. And you're also protected from inflation and deflation in those scenarios, because it just doesn't matter. All you care about is the ratios going up and down against each other. So that's probably what I would do, because you can make a ton of money doing that. A ton. So I'll stop it there. I think I covered the majority of questions that people had. If you guys like this analysis or video, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.